Hey, good evening. Good evening, everyone. Good evening.
Good evening, Professor Han.
Good evening,
Yeah, how
Professor.
are you? Good evening, Candice. Good evening, Devin. Hi, how are you? How's everybody? I
Good
see
evening,
12
Professor.
people. Hi, Awa. I
Hi.
see 12 people here, right? 12 people, but in the let's see, in the forum, I see at least 15 people. So we're missing still three, and hopefully, they're gonna. Yeah, one person is still joining, so hopefully, they're all gonna join us shortly. Um, so let me. Okay, this. So basically, we talked about almost everything, right? Um, uh, in our last session, we talked about price earnings and market price to book value ratio. So if one thing we didn't talk about, if there was one thing, it was fixed charge coverage. So fixed charge coverage is it's just like coverage ratio. But look, think about it. EBIT, EBIT over interest is the coverage ratio or times interest earned, right? EBIT or, but fixed charge coverage is, basically adding in lease payment because interest and lease payments are fixed payments, right? Fixed charges. And to be able to cover that, you should have at least, enough EBIT uh, and on top of the EBIT, there must be enough earnings. So think about it. What can there be, additional I mean, EBIT is the only earnings, but uh, if there is lease payments, so it's like this. Uh, this is the lease payment that you have to pay. This is the lease payment that comes in. Um how how is that how is that possible? I mean, if you're renting out something, then there will be a lease payment that comes in. Usually, and the interesting thing is why I don't know why they did it this way, uh, but uh, lease payment would be part of the EBIT normally, isn't that right? Why? Uh, Simply because in the income statement, right? If you have rental income, right? If you have rental income, yeah, 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 yeah. Okay, I'm gonna uh, because you know very well in the income statement, we know most of the income is revenue, sales revenue, right? But then there is investment income, right? Or rental income here, right? Rental income will be uh, part of the passive incomes, right? So should I put it like this, or and then there can be rental income, okay, and CGS OPEX, right? And then the result is EBIT, right? Subtract. So if ever EBIT would already, rental income will already be included in the EBIT. But, if they didn't have particular rental income, I mean, if they didn't originally include it here, if they didn't originally include it in the income, then they will have to separately add it, right? Because uh, think about it. If you uh, because its coverage ratio is basically times interest earned rate ratio times interest earned, and then which is basically EBIT over interest. But the lease payment that you have to make, right? Cash coverage, right? Cash coverage ratio. I mean, the use of cash is basically, you cannot run away from, interest, and you cannot postpone or avoid paying using cash to pay uh, interest and lease payment, right? So, but the source of the funds for that will have to be, EBIT, right? So normally, that would be enough. But adding, if it is the same lease payment, no, that doesn't make sense, right? If it is, if this and this are the same, that doesn't make any sense, right? Because this is not your, if this is the lease pay, think about it. If this is the lease payment that you owe, this is what you owe, it cannot be paid from what you owe if this is the same thing. You understand what I'm saying? If these two are the same thing, same lease payment, that means this is the lease payment that you owe. And if this is also the lease payment that you owe, then they cannot be those. One is, one is the cash outflow. The other one will have to be cash inflow, right? You cannot pay cash outflow with cash outflow. That doesn't make any sense, right? But so this is cash inflow, right? This has to be cash inflow, right? So if you are renting out some property, renting out, commercial space, commercial property, or warehousing space, or whatever, just an empty lot or whatever, uh, that would be the source of cash inflow, right? And then the rent payment or lease payment, that's, that's the source of, cash. And then, this is the lease payment that you owe. I mean, for, renting or leasing, uh, property or equipment. So that's the only thing. Otherwise, we've done everything, right? We've done everything. So we are moving out of, we are leaving, that ratios, ratio categories, and moving on to the DuPont chart or DuPont equation. What's the DuPont equation? It's sort of like a elegant theory. I don't know if you have ever watched the movie, the not Beautiful Mind, but what the movie Theory of Everything. Has anybody seen that movie, The Theory of Everything? It's the movie about, Dr. Stephen Hawking, right? Of course, there was in the 1990s, there was a movie, Beautiful Mind. And The Beautiful Mind was a movie about the economist John Nash. And then, Theory of Everything is the movie about uh, Dr. Stephen Hawking, the uh, physicist. Uh, I believe he died a couple of years ago. Um, and why is it called Theory of? I mean, why was the title of the movie Theory of Everything? Because Theory of Everything is what the scientists, especially the physicists, pursue, right? Uh, it's not only the physicist, but any scientist or mathematicians. They all want to pursue theory of everything. Why? The theory of everything is Einstein also pursued theory of everything. Of course, Einstein wanted, Einstein's, uh, monumental work is, basically theory of relativity. But that wasn't theory of everything. I mean, they wanted to combine one equation. It's always one equation. They all want a single equation, not too many equations, right? There are so many equations uh, that explain, uh, like law of physics, all the laws of physics, like gravity, electron, electromagnet, whatever it may be. Uh, and quantum physics, and um, everything has different equations to explain that theory, right? Equation one, equation two, equation three, equation four, right? But since Isaac Newton, right? All these physics, theory of physics, right? All those equations, mathematical equations that explain all these theories. They wanted to unify everything. And one equation that unifies everything, think about it. That would be a very powerful equation, because if one equation explains everything, that's a very powerful equation. And not just powerful, but it's elegant. You may have seen the Science Channel, I don't know, Science Channel, or Nova, or uh, you have seen, probably a series called, Elegant Universe. Why do they pursue elegance? Elegance, because if we have one theory, and if one theory explains everything, it's not only powerful, but it's very elegant. It's very, it doesn't have to be a very, you don't have to use, so many different theories to explain everything, but just, one. And in anything that uses math, that's elegance. In economics, that's also elegance. In finance, that's also elegance. When uh, in finance, you know what CAPM is, capital asset pricing model. Although capital asset pricing model is uh, very restrictive. I mean, it works only under a very restrictive condition. And it has to be like under ideal conditions. But the reason that CAPM is still, which came out actually in 1970s, but there is nothing more powerful than, even after that, even since 1970s, there is nothing more powerful than CAPM. Why? Because CAPM is a very simple model, not a complex model, but a simple model that captures uh, the whole idea behind, how return should be determined, how the required return should be determined. And so a simple model is a very powerful model, just with just one equation, if you can explain that, instead of, too many equations, so many equations, if you can explain uh, uh, the principle behind it, right? And the logic behind it, the reasoning behind it, just one equation that explains it, that's very powerful and elegant as well. That's why, anything, that uses math pursues, elegance, right? And therefore, it's like that, it's like theory of everything. It's elegant theory. What is? DuPont model. DuPont system is a kind of, pursuit of elegance. Why? Because it unifies everything. It basically connects the ROA with ROE and ROE. It connects ROE with, ROS and other, ratios. In other words, it shows all these ratios are interconnected. They're related. That's why it is, I'm saying it's like, I'm saying it's like, theory of everything. Of course, it's not theory of everything. It's just, uh, only within fundamental analysis. Um, DuPont system is a unifying theory, sort of like unifying theory in the theory of in fundamental analysis. So let's take a look at it. First of all, we know what ROA is, right? Uh, Basically, ROA is net profit over revenue, right? Don't If you still think, oh, professor, it says net income and it says sales. How can uh, but you said, net profit and revenue. How? Um, I'm confused. If you're saying that, you've done nothing so far, right? It's not two different things. Net income, that's just another name for net profit, just another name for EAT. And sales, it's just another name for revenue because it's sales revenue, right? But then think about it. Sometimes, I told you there are two versions of ROA, right? I told you two versions of ROA. One is, uh, one version is, EAT over revenue. Of course, EAT is net profit, right? Uh, Another version is ah, what's EBIT over revenue, right? Now, I already explained to you that uh, the stockholders, the owners, equity holders, this is the relevant equity. This is what's relevant to the equity holders, right? But this will be the ratio relevant to the debt holders, right? this won't be, this version won't be too relevant to the debt holders because EAT, it doesn't belong to the bond holders or debt holders, right? Of course, it's not entirely irrelevant. Obviously, a company with high uh, a company with high ratio. I mean, no matter what, whether you use earnings after taxes or EBIT, um, the higher the number, right? The higher the number, they will like it regardless, right? Regardless of equity holder or debt holder, they will like it. They prefer, obviously they prefer a higher return on assets than uh, lower return on assets. And also, even the debt holders, this is an important number. Uh, this version is an important. It has significance. However, it doesn't directly affect them, but EBIT part of the you know the interest. That's what matters to the debt holders. So that's more relevant to the debt holders. Uh, but then if we use this version, the upper one, right? Again, we can rewrite it like net profit over revenue times revenue over total assets, right? There's no why because sale revenue and revenue they cancel out each other. So eventually, it's the same thing, right? But then think about it. First, what they did was they wrote ROA this way. Now, it won't, it will be the same thing even if they did it with, EBIT, right? Sales over sales. I mean, in other words, revenue over revenue, right? Of course, this is one, so it doesn't make any difference. But we can, no change. It doesn't affect the ratio. But then, as is shown there in the slide, then this can be rewritten as. I mean, there's not, nothing wrong, no harm, switching the denominator or switching the I'm sorry. What did I do? I was totally I was I was I was not in my I was out of my mind. This is not revenue, but total assets. Why? Uh, such right? Ah, total assets and total assets, right? But we can rewrite it as by switching the by swapping the denominator, we can rewrite this as because the whole thing one the product, right? The result of this product one change is the same. But then we come to then what is this? Profit over revenue, or sale. Revenue is sale, and revenue over total assets. Profit over revenue is called, because revenue is sale, right? That's called profit margin, right? That's called actually profit margin. So or return on, I'm sorry, return on sale, profit margin, or return on sale. That's called ROS, right? And then times total assets turnover ratio. Total assets turnover ratio. You understand what, think about it. You understand what fixed assets turnover ratio is, and what was fixed assets turnover ratio? In case of fixed assets turnover ratio, right? It is, revenue over fixed assets, right? That's fixed assets turnover ratio. But if it is revenue over total assets, then that's called total assets turnover ratio, right? So now we can explain. We can connect ROA with ROS, return on sale, and total assets turnover ratio, right? ROA is the return on sale times return on sale is nothing but profit margin, right? Times total assets turnover ratio. Total assets turnover ratio is the productivity of the total assets, right? So in other words, profit margin times the productivity of the total assets. That is, return on assets. And then further, it can further be and since return on equity is net income over equity, profit over equity, and then we can also turn it into, we can do a little, harmless transition or modification. Times sales over sale, revenue over revenue. It's basically, 1, so it doesn't make any, times total assets over total assets, 1. So it doesn't do any harm. I mean, it doesn't change anything, but we can do a little swaps here. We can do a little swap. Net profit over sale, which is ROS, right? Revenue over total assets, that's what a total assets turnover ratio, and then times total assets over equity. So we swapped it like that. Total assets over equity is called equity multiplier, right? In other words, how many times the total assets, how many times equity is the total assets? That's equity multiplier. So we can rewrite ROE as ROS times total assets turnover times equity multiplier. And then maybe I need to magnify it a little. Since we know ROS times total assets turnover ratio is ROA, so then we can replace this by ROA. So ROE is now ROA times equity multiplier, right? Makes sense? How do I get rid of this? Maybe, I'll toolbar, tool. Show high. Okay, without the menu bar, still it's there. Okay, now I'm without even menu bar. That's fine. I'll just. So now we are connecting ROE with ROA and equity multiplier. Hope this is clear to everyone. So basically, eventually, DuPont system or DuPont model is basically explaining ROE by other ratios in an integrated way. Everything is integrated, right? So in a way, it's a unifying model, and therefore it's in a way a kind of elegant pursuit of elegance, right? So by definition, ROE is net profit over equity, right? And net prof equity equity, we can rewrite it like what is pre-tax profit? Pre-tax profit is EBT, right? Isn't that right? Right before tax is EBT, so it's another name, another way of calling it EBT. Then we multiply it by pre-tax profit over EBIT, and then times EBIT over sales, times sales over revenue over assets, times assets over equity. In other words, by doing harmless swap, because I don't know if you can see, but yeah. How do I? No, that's not tool, not homes. What do I do? No, won't be necessary. Okay, I'll have to write it on the whiteboard. And okay, so ROE, which is basically EAT, or net profit over equity, and do some harmless transitions. We'll do some harmless transitions. Times, basically, let's do this. EBT over EBT times EBIT over EBIT, right? You see, they are all one because it's just ratio of on itself, right? What else was there? Revenue over revenue, total assets over total assets. Total assets over total assets. So basically, they are all, one, 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 one. So it doesn't, do anything. It doesn't affect. But then if once we, swap, some denominators. The first one was what? EAT over, what was the swap? EBT, right? And then EBIT over EBT was EBT over EBIT, EBIT over. And then EBIT over revenue, right? And then total assets over equity, right? What's missing? What was missing? EBIT over revenue, revenue over total assets. Yeah, yeah. Revenue over total assets. Revenue over total assets. And total assets over equity. So what is this? We did a little swap of the denominators. I mean, but it's a product. The whole thing is still the same thing, right? And then it basically all cancel. It will all cancel out, right? EBT, EBT will cancel out. EBIT will cancel out. Revenue will cancel out. Total assets will cancel out. So eventually you will have EAT over equity left eventually, right? Because everything cancels out like this, cancels out like this, cancels out like this, cancels out like this, right? But I'm not gonna. I'm just showing you that it doesn't do any harm to the whole ratio, the entire ratio. But then they can be, they have all different names now. They have names now. What is the name? This is called, uh, so the names that we recognize, first of all, EBIT over revenue. That's ROS. Again, ROS, remember ROS can have EAT on top or EBIT on top. I mean, EBIT on top, right? EBIT, because from the debt holder's perspective, EBIT is more relevant number than EAT. Um, and the revenue over total assets is total assets turnover ratio, right? Total assets, writing, it's really total assets turnover ratio. And this is what? Equity multiplier, right? Total assets over equity. How many times the total asset, how many times the equity is the total asset? That's called, equity multiplier. The names, just names are interpretations of really this mathematical, relation between the variables, right? Equity multiplier. Multiplier. Okay. Then what are the others called? Let's see what they named it. Revenue over, asset over equity multiplier, right? And then others are named. Others also have name. EBIT over interest payment is, of course, times interest earned or interest coverage ratio. But I don't see particularly. Okay. Oh, here's the complete interpretation. Net profit over equity, which is ROE, is basically, net profit over EBT. That's called the tax burden. That's called tax. That's literally tax burden, right? Because the difference between EBT and EAT is the tax, right? So this ratio will represent the tax burden. But the higher this ratio, the lower the tax burden. The lower this ratio, the higher the tax burden. Think about it, because the difference between the two is the tax, right? So obviously, if EAT is bigger, I'm not saying bigger than EBT, but if tax is smaller, EAT will be bigger. Then the ratio will be bigger, right? So the higher the ratio, the lower the tax burden, right? The lower the tax, this ratio, the higher the tax burden. Okay. Net profit over EBT tax burden. That's the tax burden. And between, EBT and EBIT, it's the interest. So that's the interest burden, right? Interest burden. Right? The difference between EBT and EBIT is the interest. So if interest is there's a lot of interest, right? EBT will be smaller. Isn't that right? If interest is big, EBT will be smaller. If interest is small, EBT will be bigger. So the ratio will become, if interest is high, the ratio will become smaller. If interest is a lot, the ratio will be, if interest is a lot, EBT will be smaller. So the ratio will go down. If interest is small, EBT will be bigger. Interest burden will be smaller. So this is, interest burden. And ROS, another name for ROS is profit margin, right? Return on sale, right? I told you another name for that is profit margin, right? And then TATO, right? Uh, TATO, total assets turnover ratio, and equity multiplier. Now, then you can switch these two. It doesn't matter. You can switch these two. So tax burden times profit margin times interest burden times equity multiplier. But then think about it. Profit margin times total assets turnover ratio. We already know ROS times total assets turnover ratio. That's ROA, right? We've done that before. Right? ROS times total assets turnover ratio, right? That's ROA, right? TATO. ROS times TATO. So we can simply, these two, I cannot even highlight it. So if I rewrite everything again, interest burden times equity multiplier. Equity multiplier. And since we know that this is ROA, we can rewrite it as then tax burden times ROA times, now interest burden and equity multiplier, that's also called compound leverage factor. Interest burden times equity multiplier is called compound leverage factor. So what does that mean? Interest burden is basically compound leverage factor. And then think about it. If you think about it, for leverage, there is interest payment. for leverage, for borrowing money, right? Or for debt, there is, interest burden. So the equity multiplier is basically the inverse, the reciprocal, not the reciprocal, but what should I say? Is the think about it. 1 minus equity multiplier. Equity multiplier is what? If you further think about it, what is equity multiplier? Equity multiplier is total assets over equity. So if you take the reciprocal, in other words, -1, what is that? Equity over total assets, which is what? Equity ratio. And then equity ratio is, in other words, that's the counterpart. Counterpart to what? Debt ratio. Isn't it right? In other words, this is 1 minus debt ratio, which is, total debt over total assets, right? Which is, debt ratio. So so we can, since the reciprocal of this is this, right? Reciprocal of this is this, then if you what I'm trying to say is one minus debt ratio is equity ratio, and 1 minus equity ratio is debt ratio, right? Also. Right? So the whole point is, right? Interest burden is not directly related to the equity multiplier, but it is vicariously related to equity multiplier, because equity multiplier is basically the reciprocal of the equity ratio, and which is, which is 1 debt ratio, right? 1 minus debt ratio. Equity ratio is 1 minus debt ratio. So it's vicariously related. Interest burden is vicariously related. That's why it is called compound leverage factor. Compound leverage factor. Okay? It's just name. I mean, to actually bring it to an operational level, you will have to Anyway, go back to uh, uh, you will eventually have to go back to EBIT, um, EBT over EBIT, right? And then times equity multiplier, right? Now, so basically, that's the interpretation of all of this. In other words, it boils down to basically connecting everything to ROE and unifying ROE with, unifying all of this under ROE. So then they even produced a chart. They presented a chart called, modified DuPont chart. And it's basically, how ROE, everything, it's like a tree. Everything all boils down to, or everything all leads to ROE, right? Like, like the saying, all roads lead to Rome, right? All, uh, everything, all variables, I mean, all ratios uh, lead to ROE. And it pretty much, sums up the whole idea behind all this. First of all, we know ROE is ROA times what is this? Equity multiplier, right? What is ROA? ROA is profit margin, ROS, which is this is ROS. Think about it. This is ROS. Uh, uh, you know, this is profit margin, right? This is profit margin, um, which is ROS times total assets turnover ratio, right? ROA is profit margin times total assets turnover ratio, and profit margin is what is this? EBIT minus interest, yeah, which is EBT, right? Times 1 minus tax rate. So after paying tax, that's whatever is left, right? So that's what? EAT, that's profit, right? Net profit. The whole thing means net profit. From EBIT, if you subtract interest, that's EBT. From EBT times 1 minus tax rate, that's what's left after paying taxes. So it's EAT. EAT over revenue or sales, right? Revenue, sales, the same thing. That's ROS, right? Which is also called profit margin. Times total assets turnover, right? That's ROA. And total assets turnover is revenue over total assets. Okay, ROA breaks down like that. And what's profit margin? Again, it was already explained, but again, breaking down profit margin. 1 over sales. 1 over sales means dividing by sales, and net income. In other words, net profit. What's net profit? EAT, EBIT minus interest times 1 minus tax rate, corporate tax rate. That's what that subscript means. So in other words, it's just this picture, right? And what's net profit? Net profit is, or EAT, it's basically sales revenue minus total cost, right? Total cost means CGS plus OPEX. CGS plus OPEX, total cost is CGS plus OPEX. And then also you must subtract interest and preferred dividends. Preferred dividends means dividends on the preferred stock. Usually, not discussed very often, but if the company has preferred stocks, that outstanding preferred stocks, that they will have to pay dividends on the preferred stock, which is almost like interest because it's not. You can pass up some preferred dividends, but usually it's like dividend. I mean, it's like interest payment. And then you have to subtract taxes, right? But then, but add in, you have to add in uh, depreciation. I mean, depreciation is cash flow, preserved cash flow. You understand that, right? Um, but you're not adding in depreciation here in this case because it's part of the total cost. But most of the times, depreciation is already included in the operating expenses. It's just redundant to put depreciation here, but I don't know why they just put depreciation as a separate variable, um, which means they didn't include that in the operating OPEX, right? Normally it is included in the OPEX. They just wanted to probably make sure. So that explains what profit is, what net profit or EAT is. And then explanation of total assets turnover. We know it's revenue over total assets. So sales over time, 1 minus total assets. That's, total assets breaks down into fixed assets and current assets, right? And current assets break down into inventories, cash and cash equivalents, and short-term investments. So it's just a breakdown of, ROE into its origins, right? Origin, right? Of course, then it would include, scrutiny. It would include, it would inevitably require inspection and examination of the income statement, right? And, balance sheet. Profit margin that comes from income statement. These are all income statement line items, right? Income statement components. And these are all fixed assets, current assets, balance sheet components, right? Balance sheet components. Isn't it right? Those are all balance sheet components. So this is modified to Pont chart, okay? ROE all traced back to its origins, right? So in a way, I said, I don't know how many of you can find beauty in this, but there is, I'm not saying it is, I don't know. To me, it's not the most aesthetically perfect picture, but at least this is a picture that um, that captures everything in a single diagram. So in a way, it's unifying and elegant, right? It's not perfectly elegant, but still better than not. And also, this is in a way elegant, but I don't like this that much. I mean, this type of explanation, I don't like. Compound leverage factor. I don't like that kind of uh, uh, naming that much. But yeah, interpretation of tax burden, interest burden, profit margin, Tato, equity multiplier, perfectly makes sense, right? It's unifying and it's elegant. I mean, to me, at least, it looks unifying and elegant. Okay, so the rest of it is, some, example, and then another way it can be, it's basically, we know what this means. EBIT minus interest, that's EBT. EBT times 1 minus tax rate, that's EAT, right? Just in, table, right? Put it in. And again, then the limitations and weaknesses of ratio analysis. Yeah, of course, they have, limitations and weaknesses, but, compared to its strength and its usefulness, uh, the usefulness and strength far outweighs, right? The usefulness and strength far outweigh the limitations and weaknesses, right? Well, of course, it's not bad to know what are their, weaknesses. Okay, so any questions so far? Any questions? Where am I? Any questions? Well, that wraps up. If you don't have any questions, that wraps up everything about the ratio analysis. So in our next class, we will move on to topic 3, right? And net present value and internal rate of return. I mean, the title of the topic is capital budgeting, right? Capital budgeting. And one more thing, I almost forgot. Next Monday, we return to in-person mode, right? Everyone is aware of that, right? Next Monday,
Yes.
we're in-person mode. Okay, and also, I already posted a announcement about midterm, but I made a little modification. It was March 25th. Yeah, March 25th is this Friday. That's fine. You can do it this Friday, but I just postponed it 1 week, right? So it will be next Friday. Okay. We just finished everything about topic 2. All righty. So if there are no further questions, have a great evening.
I have a question.
Yeah. Awa, so just stick around. Stick around. Let me
So the
dismiss the class and take your question. Okay.
all right, all right.
All righty. So class dismissed. See you guys next Monday in F707. And so stop recording.